So when you think Sony, what pops into your head first? PlayStation? Maybe their movies?
Yeah, definitely. Or, their cameras, the sensor tech. It's usually the high growth, flashy stuff.
Right, the cool tech. But there's this other massive piece of Sony, isn't there? Something way more stable.
Oh, absolutely. Sony Financial Group, SFGI. It's often overlooked, but it's a giant. We're talking life insurance, banking, credit services, huge, steady cash flows.
It's almost like two different companies living under one roof.
Yeah.
And that kind of tension, that's really the core of today's big news, right?
Precisely. Sony's decided to spin off this entire financial unit, make it its own separate, independent company.
It's a massive move. So our mission today really is to unpack this whole thing, figure out the mechanics, the strategy behind it, and crucially, what it means if you actually own Sony stock right now.
Yeah, let's dive in.
Okay, let's start simple. What exactly is a spinoff? It sounds complicated.
It does, but the concept is pretty straightforward. Basically, the parent company, Sony here, carves out a piece of its business, the financial group in this case.
Okay.
And it creates a totally new publicly traded company from that piece. The key part is how they distribute it. They give shares in this new company directly to their existing shareholders.
Ah, okay. So you don't buy into the new company.
Nope. If you own Sony shares, you automatically get shares in the new financial company. Your ownership just kind of splits.
Right. So if I had, say, 100 Sony shares before this happens.
Then after the spinoff, you'll still have your 100 Sony shares, plus you'll have a certain number of shares in the new Sony Financial Group, SFGI.
So the total value is still there, just in two different stock tickers.
Exactly. Think of Sony as a big tree. They're carefully cutting off a major branch, the finance branch, and planting it nearby so it can grow into its own tree.
Okay, I like that analogy.
And you, the shareholder, you still own a piece of the original tree and a piece of the new tree. Your overall slice of the forest, so to speak, stays the same, just structured differently.
Got it. So the big question then is, why? Why do this now? Why break up such a successful, diversified company?
Well, the main driver, everyone seems to agree, is unlocking value. There's this thing called the conglomerate discount.
Right, I've heard that term.
Yeah, the market often struggles to value companies that do wildly different things. The steady, predictable profits from insurance just don't get the same multiple as, say, the potential blockbuster growth from the next PlayStation.
So bundling them together means the finance part gets undervalued.
That's the theory. By separating them, the idea is that investors can value each business on its own merits. The financial services part can be compared to other insurers and banks, and the tech entertainment part can be valued against its peers. Hopefully, the sum of the parts ends up being worth more than the bundled whole.
It's like trying to rate a restaurant that serves amazing pizza, but also, I don't know, does car repairs. You just average it out and maybe undervalue both.
Huh. That's a pretty good way to put it, actually. Yeah. And beyond valuation, it gives SFGI autonomy.
Autonomy, how so?
As its own company, SFGI can raise its own capital, maybe make acquisitions in the financial space, set its own dividend policy, all without needing approval from the tech side or competing for resources with, the next big game launch.
So it lets the finance guys focus on finance and the entertainment guys focus on entertainment.
Exactly. Strategic focus for both sides.
And there was something else that kind of opened the door for this, wasn't there? Something about Japanese regulation.
Oh, absolutely crucial. Japan's 2023 tax reforms. This cannot be overstated.
What changed?
Well, previously, doing a spinoff like this in Japan could trigger really significant capital gains taxes for shareholders. It made these kinds of restructuring moves very unattractive, frankly.
Ouch. Yeah, that would kill the deal.
Right. But the 2023 changes created a path for these qualified spinoffs to happen on a tax-neutral or tax-deferred basis for shareholders. That single regulatory shift basically removed the biggest roadblock.
So the tax change made it feasible, and the valuation and focus arguments made it desirable.
That's a perfect summary. It unlocked the potential for this strategy.
Okay, so we've got the why. Now, let's get practical. For someone listening who holds Sony stock or maybe Sony ADRs in the US, how does this actually play out in their brokerage account? This is where it gets interesting, especially with the ratios.
Right, the mechanics. It's a bit different depending on whether you hold the Japanese shares or the US-listed ADRs.
Let's start with Japan. Simpler there.
Very simple in Japan. If you hold ordinary Sony shares listed on the Tokyo Stock Exchange, it's a clean one-for-one deal. One Sony share gets you one new SFGI share. Easy peasy.
Okay, straightforward. Now, the U.S. American Depository Receipts, ADRs. gets a bit more complex here.
It does. So each Sony ADR represents one underlying ordinary share of Sony. You'd think it would also be one for one.
But it's not.
No. While your entitlement is based on that one-to-one value, you are entitled to the economic value of one SFGI share per Sony ADR you hold. The way you actually receive it is different.
How so?
You'll receive 0.2 new SFGI ADRs for every one Sony ADR you currently hold.
0.2. So a fraction. Why do they do that?
It's usually about managing the price per ADR and administrative stuff for the U.S. market. Sometimes they bundle multiple underlying shares into one ADR, or in this case, they issue fractional ADRs from the spinoff to keep the price point of the new ADR in a typical range.
Okay, so let's use an example. If I own, say, 20 Sony ADRs.
Right. If you have 20 Sony ADRs, you wouldn't get 20 new SFGI ADRs. You'd multiply 20 by 0.2, which means you'd receive 4 new SFGI ADRs.
4. Okay, so the underlying value is the same, the value of 20 SFGI shares, but it's packaged into 4 ADR units instead of 20.
Exactly. The key takeaway is no value is lost. It's just packaged differently for the U.S. market listing. It might look a bit confusing at first glance, though.
Definitely something U.S. investors need to be aware of. And the timing.
Yeah.
When does all this happen?
Okay, key dates to circle. The ex-dividend date is crucial, September 29th, 2025. You need to own the Sony stock before this date to qualify for the spinoff shares.
Got it. Own before September 29th, 2025.
Then the official record date when they take the snapshot of who owns what is September 30th, 2025.
Okay.
The new SFGI shares are expected to start trading on the Tokyo Stock Exchange also on September 29th, and the whole distribution officially becomes effective on October 1st, 2025.
Right. So come October 1st, what changes for me as a shareholder? What does my portfolio look like?
Well, instead of just seeing Sony Group in your account, you'll now see 2 separate lines. Sony Group, the tech and entertainment company, and Sony Financial Group, the independent finance company. You own both.
2 distinct investments now.
Exactly. And from Sony Group's perspective, a big change is in their accounting. They won't consolidate SFGI's results anymore.
Right. You mentioned that affects their reported profits. What does that mean in practice?
It means when Sony reports earnings after October 1st, their total revenue and profit figures will look smaller on the surface because that whole chunk of financial services income is now gone from their books.
Which might initially spook some investors if they don't understand the context.
Potentially, yes. But it's not because the business shrank or failed. It's just a reclassification. The market should understand this, and the hope is it allows investors to focus purely on the performance of the remaining entertainment and tech businesses. That's the whole point, reducing that conglomerate discount we talked about.
So clear valuation, hopefully. Let's zoom out a bit. What are the big potential upsides here, the opportunities?
Okay, pros. Number 1 is definitely that value unlocking potential we keep hitting on. Letting the market properly value SFGI as a standalone financial entity.
Getting it out from under the Sony tech shadow.
Precisely. Second big pro is strategic clarity for the remaining Sony Group. Management can now laser focus capital, time, talent, everything on PlayStation, movies, music, censors their core growth areas.
Less distraction.
Less distraction, sharper focus. And third, don't underestimate the significance of this being the first major spinoff under those new 2023 tax rules in Japan. It sets a precedent, draws a lot of investor attention, both domestic and international. Success here could encourage others.
Okay, those sound like strong arguments. But what about the risks? The downsides? This kind of corporate surgery isn't guaranteed to work perfectly?
No. Definitely not. There are real risks. We already touched on the immediate earnings adjustment for Sony Group profits looking smaller. That's more of a perception issue, but still a factor.
What else?
Market volatility for the new SFGI shares is a big one. When a new stock lists, especially after a spinoff, there can be initial selling pressure. Some institutions might have mandates that don't allow them to hold a pure financial stock, or some investors might just sell what they don't understand, especially with the ADR fraction.
So the SFGI stock price could bounce around a lot initially.
Very possible. Then there's execution risk. Can SFGI truly thrive as a standalone entity? Will it retain top talent? Will clients feel as secure without the explicit backing of the giant Sony conglomerate? These are open questions.
And you mentioned the brand. SFGI keeps the Sony name. Is that purely a positive?
It's double-edged, isn't it? The Sony brand carries immense trust and recognition, which is great for a financial company starting out independently, but it also means SFGI isn't fully separate in the public's mind. If, hypothetically, the main Sony group faced some major reputational issue down the line, could it unfairly drag down SFGI's perception and stock price, even if their businesses are totally separate?
Yeah, that's a subtle but important risk. Brand entanglement.
Exactly. And the complexity, especially for U.S. ADR holders with that 0.2 ratio, might cause some initial confusion or selling.
So wrapping this section up, real opportunities for value and focus, but also real risks around market reception, execution, and brand.
That's the trade-off, yes.
Okay, so let's try to bring it all together. What's the big picture takeaway here?
Well, fundamentally, this is about Sony trying to optimize its structure for the modern market. It's recognizing that the conglomerate model, while powerful in the past, might not be the best way to maximize value for these very different businesses today.
So sharpening the focus.
Sharpening the focus, giving both companies room to breathe and pursue their own tailored strategies. For you, the shareholder, it means you automatically go from owning one complex, diversified company to owning two more focused, potentially easier to understand companies.
Each with its own risk and reward profile.
Precisely. Sony Group becomes a purer play on entertainment and tech, potentially higher growth, but maybe more volatile. SFGI becomes a stable, dividend-focused financial powerhouse.
It's quite a transformation for a company like Sony, which started in electronics and just kept adding layers, gaming, movies, music, finance. Now it's strategically peeling one layer off to let it stand alone.
It really is a landmark move for them, and it potentially unlocks more value from both pieces in the long run.
And thinking about the future, you mentioned this was enabled by those 2023 tax reforms in Japan?
Yes, that's the really interesting angle going forward, I think.
So what's the provocative thought we leave listeners with?
It's this. Sony, a global giant, just successfully used these new rules to execute a massive spin-off aimed at unlocking value. They've paved the way. The question now is, who's next? What other huge Japanese companies have valuable divisions kind of hidden inside a conglomerate structure, just waiting for a similar move now that the tax barrier is gone?
Interesting. So we could see a wave of similar spin-offs in Japan.
It's certainly possible. Sony might just be the first big domino to fall. Definitely something to watch in the Japanese market.
A fascinating possibility.
Yeah.
Well, this has been incredibly insightful. Thank you for walking us through this complex, but really important shift at Sony.
My pleasure. Lots for investors to consider.
Indeed. And thanks to all of you for joining us for this deep dive. Just a reminder, we are not certified financial advisors, and this content is only for educational purposes.
That's right. If you are considering making any investment decisions based on this discussion, please consult with a certified financial advisor first.